Morning, everybody. Welcome to our campus here in Mountain View, and for those who are participating online, thanks for coming out. Hey, in the next few minutes, I want to talk to you about three things. First of all, share my perspective on 2016, talk about how our financial principles are guiding and informing our long-term financial planning, and then thirdly, connect the dots between some of the strategies and the priorities you've heard talked about already this morning, how those fit in and how those lead to our financial guidance we've already given you for 2017. So first, a word about 2016. I think a great place to start is always to look at what we said last year. You know, we're pretty rigorous about doing that. And so the left-hand side of this slide is actually the summary slide from my last presentation. And we're quite pleased with our performance in 2016. As you've already heard, it was a great year. Very strong growth in our online ecosystem, customers and revenue, margin expansion, margin improvement, very strong growth also in our cash flow and in our operating earnings per share, reduced our share count, returned about $2.6 billion to shareholders in a combination of dividends and share repurchases last year, as we had the proceeds from those asset sales you heard mentioned earlier, and a return on invested capital 37% last year. So very strong year, that's all great. 2015 was a good year too. So we're pleased to show continued improvement both in growth and in margin improvements. And we entered 2017, we're about a little over 6 weeks in now, with a much tighter strategic focus than we've ever had before, with a lot of momentum and a lot of wind at our back. So we're excited, we're optimistic about 2017 and moving forward. If you've been around for a while, like most of you have, you've heard us talk about our financial principles. I want to spend a few moments of those. We think they're still incredibly relevant. Think about these as a set of guardrails or a set of parameters that we use to guide our long-term thinking. And it informs our discipline and talks about how we measure the different parts of our financial planning, the different levers that we have. You've heard us talk about the first one a lot, and it's the hardest one to achieve. Our first financial principle is to grow revenue organically at 10% or better. Hardest one to deliver, hardest one to achieve. We've delivered this 4 out of the last 10 years. 4 out of the last 8 if you drop off the worst recession year and the year that we went through the ratable transition. But it's still a difficult metric to achieve, and we get that. But we consider it, and we still think it's relevant. More about that going forward. But just a word here, when you think about and look at the opportunity we see with the available customers in the addressable market, we think it's reasonable of us to achieve this goal and reasonable of you to expect it over the longer term. More about how we plan to do that in a second. Margin expansion just basically means that we grow our expenses at a slower rate than our revenue. We think this is an element of good management discipline, and we're committed to this over the long term. I know sometimes people think about, will we get to a point where this plateaus or is there a ceiling? I can tell you there's not one we see in our planning horizon, and we just think it's an element of good management to prioritize the $3+ billion we will spend in 2017 on those items that are the most directly connected to the priorities and the initiatives that we've outlined and to achieving customer growth. So this is about prioritization, it's about discipline. We have plenty of money to spend, but we're committed to delivering this. We've delivered it 8 out of the last 10 years, and as we'll talk about it in a moment, our guidance for 2017 shows another big step in that direction. When you think about how we allocate or how we use the cash internally, it's always the first priority for us to invest internally in ways that grow the business. Some of these show up on the expense side of our income statement. Sometimes they show up on the revenue side through lower prices, promotional, discounting, things like that. You'll see more, we'll talk more about that in a second when we get to revenue per customer. But we always want to invest in the business first. But we do hold ourselves to the rigor of having an internal rate of return, 15% or better. That's where the benchmark where we start over a 5-year period. And we want to be realistic about the investments we make in our business. Are they going to generate a return? Are they going to generate some goodness? And that's the bar that we set. I think acquisitions will continue to be a part of the way we build out our product roadmap, maybe the way we enter new markets. And so when you look at the tech tuck-ins, the tech and technology and talent tuck-ins we've done in the last couple of years, I think that's added a lot to our capability and capacity. My expectation would be that we would continue to do those in 2017 and beyond. And as you know, the company generates a lot of cash flow, roughly in line with our operating income in a normal year. And we usually have cash to return either through share repurchase or through dividend increases like we've already announced for 2017. That's going to remain a critical part of our capital allocation toolbox. And then finally, our fourth goal just talks about making sure we have a strong balance sheet, which means that we can invest even in times of economic slowdown or take advantage of opportunities that may come along. Even if they come along at some point in the cycle during the year, we have cash and we have the ability to do that. Now, you've heard a lot about total addressable market, a lot about customers. This is what's driving the revenue growth that we've guided for 2017 and what will drive beyond that. In a nutshell, what you see here is that we expect our active small business customers, those who pay us something every year, to roughly double over the next 3 years. And we expect the number of consumer tax returns and small business tax returns in the US that are completed with our software to grow by 1/3. And so it's all about customer count. It's all about getting deeper penetration into these addressable markets that Brad and Sasan and Dan and CC have outlined for you. We get those customers counts coming in. That's what's really driving the revenue growth. Here's our revenue per customer, 2015 versus 16, and our expectations longer term. QBO, both in the US and outside the US, was roughly flat year to year. This time last year, we told you we expected a slight increase in ARPC in the US. What's changed from our plans is that we anticipated more of our customers, more of the growth in QBO would be desktop converts, people who came over from desktop at a higher ARPC. The good news is we exceeded our customer expectations both in desktop and in online, both in terms of customer counts and revenue. So you see improved revenue per customer in terms of desktop. You know desktop did fine in 2016, but it caused some contraction in our ARPC, slight amount of contraction in the US and about flat worldwide. No matter what business unit you think about at Intuit or which initiative or priority we focus on, it's a good thing when you see customer growth outpacing revenue growth, because we've demonstrated over time that we are very good at monetizing customers. Once they get the benefit from the products we deliver, once they get accustomed to them, once they get in the franchise, we've been very good at moving up with them, up the product lineup SKU, or selling them additional features and services. So job one for us, and you know we're going to have a good future when you see customer growth outpacing revenue growth in the short run, about flat with QBO in 2016, US and outside. QuickBooks Self-Employed had a nice increase in average revenue per customer in 2016. But as you can see, we think price is a critical lever, and promotions are a critical lever to get the customer growth we want worldwide in 2017 and beyond. So we're not building our plans assuming additional expansion in ARPC and QuickBooks Self-Employed. We actually have it going flat to down. And so all those on a weighted average basis show the average revenue per customer in QuickBooks Online ecosystem down slightly, 2016 to 15 to 16. That's what we talked about last year. That's what we told you to expect. And again, it's a great thing. Remember that our online ecosystem revenue grew 25% in 2016 on a customer growth base of 41%. And our plans for 2017 and beyond show those accelerating rates from where we were in 2016. I mentioned desktop already, and you've seen our revenue per customer in consumer tax and in pro tax being roughly the same. The theme is very consistent, I think, in all these revenue per customer projections, is that we're looking for customer acquisition to really fuel our revenue growth. We don't want price to be a barrier. We don't want that to be a reason for non-adoption in the short run. More on that in a second. Overall, 3 points to make from this picture, from this chart. No surprise to you, our online ecosystem, both in tax and small business, is what's driving our revenue growth over the next few years. Our plans now show that will be 60% of our total revenue would come from QBO and from TurboTax Online by 2019. Notice the blue panel on the top. This is the QuickBooks Online ecosystem. And as you can see, the widening of this layer on the very top just demonstrates the acceleration that we expect in our online ecosystem growth over the next few years. The third point to make here is that desktop will remain a big part of our revenue stream for the foreseeable future. These are great customers. We love them. They're very profitable. They're very loyal to our product base, and we hope to help many of them convert to online services whenever they're ready and whenever they come to us. So it's going to be a big part of our revenue stream, profitability, and cash flow for the next 3 years. All right, let's talk about what we do with the money that we make. You've seen this chart before. I've revised it slightly to show every line but the bottom one on a GAAP basis. And I did that for a very simple reason. We're tending to think more about our goals and targets internally with including stock-based compensation. No surprise to you, but equity is a bigger and bigger component for recruiting and for retaining employees. And it's an expense, just like everything else we do. So the goals, targets we have here, this is for 2016, are shown on a GAAP basis. So don't get distracted by that, but that's the change. The point is, when you look at how we think about our margin management going forward, our gross margins are still in the mid-80s. We don't really see that changing. We don't see pressure on that over the planning horizon. So we think our assumption is that's going to stay about the same. But all three of our major expense categories, sales and marketing, research and development, and our general administrative costs, we think should grow more slowly than our top line revenue over the next few years. And so we think there are opportunities there to reallocate what we're already spending, to put some discipline and curbs in place internally to make us move money to the most critical resources and to the most critical initiatives, and measure ourselves against driving our cost growth more slowly than our revenue growth. And so we think there's opportunity to continue to deliver margin expansion and to continue to invest for the future. If you followed us for a number of years, we increased sales and marketing a couple of years ago when we began our global expansion. It's at a level now where we think we can continue to grow and expand and make the investments we need, both in sales and marketing and in research and development, but still at a level that provides some margin expansion going forward. You've heard us talk about getting margins back in the mid-30s after we go through the business model transition. If you look at our guidance, at the midpoint of the guidance, it's about 34% for 2017, which is a point of improvement over 2016. We'll see how the year plays out, but the critical thing there to be aware of and to remember is we do think we have opportunity there, continue to invest and do things for the long term, but continue to meet our second financial principle. Sometimes people ask me, of all these priorities, how do you decide and how do you prioritize where to invest money and how do you make those decisions? Brad's staff had a long planning session back in May of last year where we brought all of our ideas, all of our initiatives to the table, and 4 critical themes emerged. And you can see them here, and you can see these are how we think about prioritization of where we spend money and where we invest. The first one gets to delivering the customer benefit. You've heard a lot of conversation about that today. I want to assure you that we use that as a way to decide how to allocate money and where to invest. We look for things that are delivering the customer benefit, things that are nurturing network effect platform opportunities within the company. And so that's a top of the list. Certainly anything that grows and causes our QBO subscriber base to thrive is critically important. So that's a key priority for us. You should know that we're continuing to address tech debt. We're investing in internal infrastructure, back office systems and processes that customers don't necessarily see directly, but it impacts our ability to serve them. It impacts our ability to deliver things to market quickly. And so at the same time, I think we're delivering good operating leverage and good operating performance. We're investing in the infrastructure and inside. So no deferred maintenance build-up here. And then finally, as you've heard already, privacy and security is job one. They get the money they need to build the things they need to keep our products and services safe for our customers. Here's another look at the money we spend. Of the roughly $3.5 billion we'll spend in 2017, about a third of it is directly related to product development type activities, and 80% of that is directly, specifically allocated to the priorities that Brad outlined for you at the beginning of the day. This is a chart we share with our employees, and it's kind of a say-do thing we do internally to be sure that our spending is really matching up with the things we said were important in our strategy deck, in our strategy slides. You can also see from this, without seeing the actual number, that we've got big increases built into our 3-year plan, and we plan to continue to invest and build product development internally. One more word on this. In addition to the monies that we had allocated across the company, Brad came in and made some additional allocations of investment dollars in 2017 and beyond in some critical things that we want to focus on. Things like our tax platform, security and data, our agent tools and infrastructure experience. So we look for areas where the business was already allocating a lot of money to those and where additional investments would help us accelerate the answer and get those problems solved faster. And so you see some of those issues and some of those areas mentioned here. A couple of slides about capital allocation. I've talked already about how we use our cash, first of all, to fund internal growth and development. But we've had a lot of cash to return to shareholders. We initiated a dividend back in 2012. We've doubled it over the next 5 years. We've announced a 13% increase for 2017. So we think that's a great tool for us to use in terms of capital allocation, and you'll continue to see it. Share repurchase has also worked for us really well. And I'm personally proud of the fact that over the last 5 years, we've generated and returned to investors 130% of the internal cash flow that we've generated, about $5.6 billion. Clearly, the proceeds we had from the asset sales in 2016 helped with that. But that just shows you, I think, that there's no incentive for us to hold a lot of cash or a lot of liquidity on our balance sheet if we can't use it in the business profitably. I think we've been good stewards of turning that back to shareholders. This is just another breakdown of where the capital allocation dollars went by different sources. We've talked a lot about the increase in property we had in 2016, so you see an increase there in our capital expenditures. We do have a debt maturity scheduled in the first calendar quarter of 2017, and we've made provisions in our cash plans for the year to retire that. We'll see how that plays out as the year goes on and see how market conditions develop. The other comment I would make on this slide is that if you look at the share count we've guided to you for 2017, you'll see that our cash allocation for share repurchase in 2017 is probably more likely to be around the average you've seen for the 5-year period. So think of something more like the 5-year average. Certainly we don't want to anticipate having the cash flow from the asset sales we had in 2016 available for share repurchase in 2017. So somewhere in the $1 billion, $1.2 billion range ought to be about right, depending on what happens as the year goes on. You've seen our guidance already. We've talked a lot about this. Clearly, our revenue guidance is not at the 10% level for 2017. We've made a very conscious decision here to really lean into customer growth and not to move too fast or too far on price and on monetization. We think we have those levers. We think we know how to use them quite well, but we think it can also be a barrier for people to adopt and use our products. You heard Dan talk about the tremendous success we had with Absolute Zero at getting people to try a product. And so we have intentionally invested in the revenue line and getting customers in 2017 and not try to go too far too fast with revenue growth. CeCe also mentioned the ProConnect plan for 2017. This is another area where we've actually guided a slight decrease there as we want to get the product and the experience and the One Intuit Accountant platform right before we really lean into price increases there. On our operating income slide, just a comment here. I know that our GAAP EPS guidance looks funny. You have to remember that we had about 65 cents a share in 2016 that showed up in GAAP results only below the operating income line as a result of the asset sales we had last year. On a non-GAAP basis, on an operating income line, you can see that we are delivering the margin expansion, operating leverage that we've talked about there with our operating income growing a little faster than our revenue line. And we expect to continue to reduce the share count, which gives us an EPS growth in the mid-teens, along with dividend growth at 13%. So I think a very good balance for the year between investing and delivering good results in the short run. And that leads me to my final slide. Brad talked about our True North metrics, solving for all stakeholders, short and long. And I think we have a plan for 2017 that is right down the fairway, that clearly delivers that. It has investment dollars in technology and expansion in sales and marketing, but it also provides some discipline to continue to provide operating leverage and margin, good growth in earnings per share and dividend. And at this point, we expect our return on invested capital for 2017 to be close to 50%. So we're expecting a good year. I hope you can tell we're excited about it. We do think we have a momentum at our back. And now I'm going to bring up Brad to facilitate your questions. Thank you.